You agree with Chanos. So let's get some key inflation data. We're going to get that tomorrow. Core personal consumption expenditures expected to rise 4.8% versus last year. That's the Fed's preferred inflation gauge. Could hold some clues for the market on whether or how big the Fed's going to hike rates next month. Seems pretty sure that they're going to. More a question of how big. Joining us now for more is JPMorgan chief U.S. economist Mike Feroli. Michael, last time we got an inflation reading that was higher than expected, the market sure did react.
Yeah, I mean, one thing I would keep in mind about the PCE, it's kind of a regurgitation of CPI and PPI data that's already been reported. So I think we kind of know what's coming tomorrow with a fair degree of precision. I think what's probably more important for that July meeting that you referenced is the June CPI report, which we'll get in a few weeks. And if that's another hot one, it looks like 75 is probably in the bag. I'd also keep an eye out, however. Tomorrow, you mentioned the PCE data. I'd keep a close eye on the initial claims data. There are some signs that the economy is slipping pretty quickly here in some of the business surveys we've seen. And the claims data is a very high frequency and very, well, somewhat reliable gauge on when we're losing momentum on growth. So I would also keep an eye on that at 8:30 tomorrow.
So, Mike, would you say initial jobless claims more important than PCE? There's been a lot of talk about PCE today, but if it's mostly just a derivative of what we've seen already, and the argument that I've been hearing is, oh, well, you know, while there's still so much employment, how can we really have a recession if employment looks like it's backing off? Is that more likely to cause people to reconsider?
Well, look, I mean, I think if employment slips here, the Fed probably will be patient for a few months before reconsidering their, hawkish path. But I do think, look, the PCE number we'll get tomorrow, I think we'll get it within probably a few basis points, just given the way the number is constructed. We have no idea what the claims number is going to be. And as I said, this week and last week, we've seen some business surveys that suggest that perhaps, I'm not trying to say, I'm not trying to be alarmist here, but there have been some signs that business sentiment is slipping pretty quickly here. And that's why I want to keep an eye on those gauges.
Help me understand what to expect here then, because the way I was thinking about it, if initial jobless claims are higher than expected, that could mean there's a greater risk of a recession because employment isn't holding up as well as some people had hoped to sort of bolster the overall economic situation. Yet you seem to be saying if initial jobless claims are higher, the Fed might actually hike less, which the market might have the opposite reaction to. What do you expect?
I don't think the Fed's going to be jumpy here on a single number. I mean, mindful of how they reacted to the Michigan inflation expectations number. But I do think for thinking about the path for the next few months, if the labor market shows signs of slipping, then that really changes the story. I mean, we already know the trajectory on housing is down. It looks like the trajectory on manufacturing is down. Consumers slowing a little bit, but holding in, and they're holding in because job growth has been, 300,000-400,000 per month, and that's the expectation that it'll remain pretty solid for the next few months. If those expectations start to slip lower, then I think this, narrative that we'll dodge a recession start to look a little more up in the air. And again, I'm not saying that. I'm just saying that there are some signs.